The Entertainment Engine, a comprehensive guide to Netflix, NFLX. As of January 2026, investing in Netflix requires looking at a company that has successfully moved beyond its DVD by mail roots to become the dominant global media conglomerate. However, for an investor today, the story isn't just about subscriber counts. It's about consolidation, advertising, and a massive bet on legacy Hollywood. Netflix enters 2026 at a critical juncture. It is no longer a high-growth disruptor, but a mature value system that is swallowing its competition. This guide breaks down the Red End's massive Warner Bros. Pursuit, its transition to a hybrid revenue model, and the unique risks of owning the world's largest digital stage. 1. The strategic shift, from growth to consolidation. The biggest headline for Netflix investors in early 2026 is the proposed acquisition of Warner Bros., including HBO and DC Studios. The Streaming 2.0 era. For years, Netflix relied on high-cost original production to fill its library. In 2026, the strategy has shifted to buying the crown jewels of Hollywood to secure a permanent competitive moat. The deal. Netflix is currently in a high-stakes battle to close an estimated $80 billion-plus all-cash offer for Warner Bros. Studio assets and HBO. The strategic accelerant. By acquiring HBO and the Warner Library, Netflix gains decades of premium content like Game of Thrones, Succession, and Harry Potter. This reduces their need to constantly gamble on new hits and provides a massive catalog to fuel their advertising business. The risk. This deal brings significant M&A, merger and acquisition, costs, and regulatory scrutiny. As of January 2026, Netflix has paused its share buyback program to conserve cash for this transaction, which has caused some near-term volatility in the stock price. 2. The business model, a hybrid revenue machine. In 2026, Netflix has officially shed its ad-free forever identity. It now operates a complex, multi-tiered revenue model that mimics the old cable TV world, but with modern data. The revenue streams. Subscription tiers. This remains the bedrock. After phasing out the basic ad-free tier in 2025, Netflix pushed users into either the low-cost ad-supported tier or the high-priced premium tier. Advertising. This is the company's new growth engine. Netflix forecasts its ad revenue will double to $3 billion in 2026. By using its own proprietary ad tech suite, the company can sell highly targeted commercials at a premium price to global brands. Live events. Netflix is now a destination for appointment viewing. With a 10-year deal for WWE and exclusive NFL Christmas Day games, Netflix is capturing the live sports audience, which is the most valuable segment for advertisers. 3. The technology. AI and cloud-first gaming. Netflix is increasingly using its tech stack to stabilize its business and find new ways to keep users locked in. AI for retention. In 2026, Netflix's AI strategy is focused on hyper-personalization, dynamic ad insertion. Using machine learning, Netflix can swap ads in real time based on your specific mood and viewing habits, ensuring that advertising doesn't lead to churn, users canceling their subscription. Creative automation. AI is being used to automate the localization of content, dubbing and subtitling, allowing Netflix to release a show globally in 100 languages simultaneously at a fraction of the previous cost. The gaming vector. Netflix has expanded its cloud-first gaming strategy in 2026. By turning your smartphone into a controller, Netflix allows you to play high-end games, like a newly reimagined FIFA simulation, directly on your TV without a console. This creates another reason for users to keep their subscription active during months when there isn't a new blockbuster show. 4. Financial performance. High margins, high expectations. Netflix enters 2026 with a fortress financial profile, though its top-line growth is beginning to show signs of maturity. Key metrics, January 2026. Annual revenue target, $51 billion. A significant jump from 2024 levels. Operating margin target, 31.5%. This is a significant jump from 2024 levels, reflecting a more disciplined approach to spending. Free cash flow, projected at $11 billion for the year. Valuation. The stock currently trades at a forward PE ratio of roughly 28x. This makes it more affordable than high-flying AI stocks like Nvidia, but it still commands a premium over traditional media companies like Disney or Comcast. 5. Critical risks, what to watch for. Before investing in NFLX in 2026, you must consider the bear's perspective. 1. The winner's curse. If Netflix overpays for Warner Bros., the massive debt load could drag down its profit margins for years. The market is currently punishing the stock, down over 5% after the recent Q4 report, due to uncertainty over this deal. 2. Subscriber saturation. With over 325 million global subscribers, Netflix has already captured a huge portion of the planet. Growth in mature markets like the US and Europe has slowed significantly, meaning the company must find ways to squeeze more money out of existing users through price hikes and ads. 3. Content fatigue. The streaming wars have made consumers fickle. If the 2026 content slate, which includes Stranger Things 5 and The Night Agent, fails to resonate, users can cancel with one click. 6. Investor strategy, how to approach NFLX. The anchor play. Treat Netflix as the blue chip anchor of your entertainment portfolio. It has the scale and the data that no other streamer can match. Watch the ad tier ARPU. The most important number to follow in 2026 is average revenue per user, ARPU, on the ad tier. If Netflix makes more money from an ad subscriber than a premium subscriber, the profit potential is massive. Post-split accessibility. Following its 10-for-1 stock split in November 2025, the shares are much more accessible to retail investors. Many use a dollar-cost averaging approach to build a position during the current volatility surrounding the Warner Bros. Deal. Conclusion. The definitive media hegemon. Netflix in 2026 is no longer fighting for survival. It is fighting for dominance. It has successfully navigated the password-sharing crackdown and the transition to advertising. By potentially merging with the Warner Bros. Library, it is attempting to become the Google of entertainment, the one place where the world goes to find everything. The verdict. NFLX is a solid buy for those who believe that digital entertainment will continue to consolidate under a few giants. While 2026 will be a bumpy year due to high integration costs and M&A drama, Netflix's 31.5% operating margin and its $3 billion ad target suggests it is a maturing cash machine.